Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. Now today on the show, we're tuning into the global economy where central banks are making moves that could shape your investment decisions. Now, the European Central Bank and the Bank of Canada have just lowered an interest rates by 0.25%, a clear sign that they're trying to stimulate their economies. Meanwhile, the U.S. is seeing easing labor costs, hinting at a possible slowdown in economic activity. So, what does these financial tweaks mean for the future of precious metals? Are we looking at a renewed rally in gold and silver, or are there more to the story here? To help us unpack these developments, we're joined by Jeffrey Christian, no stranger to our Kitco audience. He's the managing director of the CPM Group and an expert in precious metals investing. Jeff, thanks again for joining us today.
Well, thanks for having me, I guess. Yeah.
Of course. It's always a pleasure. You heard the intro there. We had some interesting economic data coming in, and I guess we'll start with that, Jeff. Considering the recent measures, including the interest rate cuts by the ECB, yesterday the Bank of Canada, as well as the moderated labor costs in the U.S., how do you evaluate the potential of these global monetary policies on the stability and the pricing of gold in the international markets and what we're looking for here?
Well, I think, vis-a-vis the ECB and the Bank of Canada, those will suggest slightly higher demand for the U.S. dollar, but they're also a sign of economic weakening. And, we have been saying for some time that there's this ill-placed wishfulness. We wish the U.S. Fed would lower interest rates. And we've been saying for a long time, don't wish for that, because the Fed will only lower interest rates when it sees significant signs of economic deterioration. If the Fed is at 5.25% and the economy is still humming and there's still more downward pressure on inflation rates than there are upward pressures on inflation rates, the Fed will keep interest rates at 5.5%. The Fed will only lower rates here in the United States when it sees signs of significant deterioration in economic activity. Now, we also have been saying for some time that we expected to see deteriorating economic conditions in the United States as well as in Europe, Canada, Japan, and other countries over the course of 2024. We are seeing that. We are seeing signs of gathering weakness, more so in Europe and Canada than in the United States, but it is there. And so we're pretty much where we thought we would be. Right. The gold price and silver price are a little bit higher than we thought would be. But the reality is that you're seeing a maturing economic expansion, increased risks of economic slowdown and or even a recession, which we've been saying was quite possible in the final quarter of this year into 2025. You have a tremendous amount of political concerns. So you put that all together and it suggests stronger investment demand and higher prices for gold and silver. So To go back to your question, the lower interest rates in Bank of Canada and the EU basically are notches in that. It's a move toward they're reinforcements of what we've been seeing and what we've been expecting. In a way that probably positive, at least for the next year or so, for gold and silver prices.
Okay, interesting. So, that brings me to the next question. Central banks are adopting this more cautious approach to inflation. How sustainable is it? Is this the precursor to a more sustained investment in gold and silver as safe havens? And more curiously, how do investors interpret this now? And what do they do here? What are some strategies in response to these central bank policies?
Well, it's interesting. And, I'm not quite sure how you define sustainable higher gold and silver prices. We have been saying, and we continue to expect gold and silver prices to rise over the next 12 to 24 months, but then we expect them to come down. And the expectation of prices coming down, we'll talk about where we think they might come down to if you want later, 2 years from now. But more importantly, it's like what's sustainable gold prices and silver prices. And, the reality is that you have investors especially in gold, have been buying gold. Silver, you're seeing strong two-way investor activity. So you're seeing increased investor buying of silver over the last 2 months or so as the price has risen. But you also have seen increased sales of silver from investors who have waited too long for $100 silver. And they're saying, look, I bought it at $30 in 2021. It's back to $30. Please take it. Let me go do something else.
Yeah, a little bit of fatigue there. Okay, before we head over to silver, let's talk a little bit more about gold. Just give me your forecast for this year. I mean, you mentioned over the next 12, 24 months, we're going to see the prices go up. Much like anything in precious metals, it's cyclical. So those ups, those high prices might, in fact, come down. But what's your forecast for the remainder of this year, especially going into this election year?
Well, we wouldn't be surprised to see a little bit of weakness over the next couple of months in gold. I don't see prices falling sharply. I think what we're actually telling our clients is that we could see, in our mind, a reasonable decline down to $2,280 or so. The price is testing $2,400 today as we speak. But we could see a range over the next 3 months of, say, $2,280 on the low end and $2,450 on the high end. Little bit of a sort of sideways move, downward move during that 2-3 month period. Into the final 4 months of this year, as you watch the U.S. election unfold, and as you have ongoing issues in Russia's invasion of Ukraine, Israel's attacking Gaza, and other international political issues, we would expect gold prices to rise. I'm not quite sure how high they rise, but for a full year average price, we could see $2,400, which would suggest significantly higher prices in the second half of this year into 2025 than you have seen in the first half of this year.
Yeah, you talked a little bit about what's causing that those prices. What benefit or what to degree does the BRICS plus, Turkey is really increasing their central bank buying here. I'm curious, has anything surprised you about the central bank buying? And is that going to sustain itself throughout the U.S. election as well?
Well, I'm not sure about BRICS buying. I think that there's a lot of misinformation floating around. Turkey, if you look at the most recent data for central bank activity, China bought a little bit more, but China was buying like 7 million ounces last year, 650,000 ounces a month. They're down, like 150, 160,000 ounces a month. And that partly reflects the higher price. People's Bank of China, like many other central banks, are very price sensitive. At $2,200, they were buyers. At $2,400, they're not necessarily buyers. The two big buyers in April were Russia, which is buying and selling gold month to month in order to finance its economy and its war effort, and Turkey. And Turkey has a traditional role in the gold market. It is one of the big market centers for gold in the Middle East. It also is a country that the economy has been really whipsawed over the last 2 years now because a lot of goods flow into Turkey on their way to Russia to avoid sanctions. Other countries will say, well, we're not going to ship stuff into Russia. Okay, we'll ship it into Turkey or Kazakhstan or Uzbekistan, and those guys will take it on. That does two things. First off, it increases the need for foreign exchange to pay for all of those goods that get transshipped into Russia. But it also is increasing the wealth of sanction-busting people and companies. Yeah. And so you also have stronger demand and higher inflationary pressures within Turkey and Kazakhstan and Uzbekistan. And as a result of that, you're seeing, those countries needing foreign exchange. And Turkey actually, I think, was selling some last year, and then they turned around and they've been buying some back. But, the Turkish government has a lot of its own problems, both domestically and internationally. And it is a traditional store of gold. It's one of two countries that really have monetary policies that are supportive and monetary regulations that are supportive of individuals owning gold as effectively as they can and using it for monetary purposes. I mean, Turkey allows its commercial banks to use gold to meet some of their reserve requirements. That frees up lira in the Turkish market and economy, and helps Turkey have a better, more liquid economy and stay out of recession. So, it's a special case there.
Yeah, definitely. Okay, well, let's talk about silver. I mean, the dual role in the market is interesting as both industrial metals and a monetary asset. Elaborate on current market conditions here a little bit. How are they affecting these two aspects of silver demand?
Well, you have seen strong silver fabrication demand in solar power and in some electronic applications. And that has come at a time when mine production and secondary recovery total supply has been relatively flat for several years. It really hasn't responded to the rise in prices. It's still sort of responding to the fact that from 2013 to 2020, the silver price was $15, $16, $17 an ounce, and it was very hard for mining companies to raise capital or even raise debt to finance exploration and development of new brownfield or greenfield mining. So you've got relatively stable supply. You have strong demand in a couple sectors, which is really tightening the supply-demand balance. But you need to think of supply in three levels. And we'll get back to that. The third level is available above ground inventories. And as I said earlier, you have any number of investors who over the course of 2023 and the first half of 2024 have been selling silver. These, in many cases, are people who bought silver at $30, $31, $32 an ounce in 2021 because they drank the Kool-Aid about, central bank digital currencies and conspiracies to manipulate the price, and the price is going to 50 or 100 or 750, as one guy in Vancouver kept touting up until last year. And the price didn't do that. And so a lot of people bought silver at $30, $32. They've watched the stock market go to new record levels. They've missed that. They've watched corporate bond prices go to new records. They've missed that. And they're saying, okay, I'm just going to sell that stuff. So what we've seen over the last 2 months is, I think I mentioned earlier, a very active two-way market in investor buying and selling of silver. There are any number of investors who have been disenchanted. They've been selling silver really for about 15 months now, maybe longer. There are other investors who watch the price break above that $26, $28 range and start moving higher, and they've gotten enthusiastic. Oh, this is it. It's going to 1,000. Yeah, we know this because some guy on the internet told me that. And he's been saying it for 20 years, and he's been wrong, but that's beside the point. Now he's right. So you're seeing some investors buy silver and run into silver, and then you're seeing other investors saying, I'm just happy to get my $30 an ounce back. So you've got two-way activity in the silver market and on the part of investors. And you've got to pay attention to the fact that investors, there's a billion ounces in silver ETFs. There's 1.4 billion ounces in silver coins. There's a lot of silver out there that investors own, that if they're disenchanted or they want to try something else, they may sell some. And some of them are selling stuff now.
So do you think then, Jeff, that there's more sellers out there than buyers? Because we've seen, these retail investors or these people that want a little bit of skin in the game. Okay, gold at these levels is too pricey. I'll buy some silver. Maybe not going to balance out here this time.
I think right now the balance, our expectation is that demand for silver will be more positive in the second half of the year for all those economic and political reasons I just mentioned. Right. And that for the full year, you will see investors as small net buyers. It's nowhere near what silver promoters talk about, when they're talking about hundreds of thousands or hundreds of millions of ounces of silver demand. Net investment demand last year was very low, like 12 million ounces. It's probably going to be roughly about the same this year, depending on what happens in the second half of the year in terms of the economic environment, interest rates, the dollar, and the political environment around the world. But right now, I think that you probably are seeing investors as pretty much neutral. They were net sellers in the first 2-3 months of the year. As the price rose in April and May, March, April, May, there was more buying that came into the market. It's probably pretty much flat right about now. I know a lot of the coin dealers that we talk to have been complaining about a large inflow of silver and gold coins and bars by people taking profits.
Mm-hmm. Okay, Jeff, we talked a little bit about that, that we can cover dual demand in silver. I mean, we get the industrial demand. Of course, we got the monetary policies or the monetary asset here. Talk to me a little bit about this recent report. I was reading this morning that according to TD, Chinese solar output cuts due to an oversupply. It's caused traders in Shanghai to sell off a significant portion of their silver holdings. Given China's huge role in the silver market, talk to me about how these actions influence the price and what investors should be keeping an eye on in response to these types of shifts.
Yeah, I'm not I'm not sure about the extent to which people are dumping silver in Shanghai right now. And it's funny because we are actually about to release the first of 2 silver market commentaries on Chinese silver prices, because there's a lot of, I think, misunderstanding about silver pricing in China on the part of the silver investment community over here. So we're in the final edits of the first of a 2-part series of market commentaries on that. But looking at solar power and its use of silver in general, there's been a big increase in the use of silver in solar panels. There's been a very big increase in the capacity to make solar panels around the world. China's the leader, but countries like the United States, Saudi Arabia, the United Arab Emirates, various countries in Europe, countries around the world are developing their own solar panel manufacturing business. And that has required additional silver. So the International Energy Agency looks at it and they say, okay, we have a solar panel industry globally now that's probably operating at less than 50% of capacity. A lot of industries don't work profitably if they're at less than 50% capacity. So you've got this situation that's there. You've got overcapacity. You had an overbuild last year, so you have inventories hanging of manufactured panels in the solar panel market. That means that solar panel manufacturers should and are cutting back on their new silver purchases and their silver and their output. Let's live off of these inventories for a while. Let's get inventories down to a lower level. But you do have this long-term overcapacity that is a real threat there. Our expectation is that silver use in solar panels, which rose very sharply last year, maybe a third of last year's build and demand is sitting in inventories waiting to be absorbed this year. We'll still see some increase in silver use in solar panels on a global basis this year and in China, but it's going to be a much smaller increase than we saw last year because of this overcapacity and these unsold inventories of solar panels. And I think that that's there. Whether or not that has led investors to sell off silver in Shanghai, I can't really talk to that right now.
Yeah, I mean, wow, that's crazy. A third of the panels in inventory. Okay, let's talk a little bit about the pricing then. I mean, silver's busted past that $30 mark. Our own Jim Wyckoff says that our next upside price is above solid technical resistance at $32.75. What's your forecast for silver this year, Jeff?
Our forecast is that the price will probably average somewhere in the $28 to $31 range. I should say that our precious metals market advisory for June comes out later today, and we'll probably have revised price projections there. But we are looking at somewhat higher prices, as we have been for some time. We've been talking about the idea of gold and silver prices spiking in 2024, 2025, possibly into 2026 for silver. And, in terms of annual average prices, getting to record levels in gold and getting to near record, if not new record levels in silver. So this is sort of what we've expected. It has to do with, again, that tight supply-demand balance, fabrication demand versus total newly refined silver. The fact that some investors are selling, other investors are buying, and there are any number of investors who holding a lot of silver saying, okay, let me see how high it goes before I sell, or maybe I should start buying again in the expectation. And, politicians around the world are giving investors all kinds of indications that they should be buying gold and silver.
Yeah. Yeah, no kidding. Okay, well then, are you looking at any mining stocks currently in hopes that these precious metal prices catch up? Is there any opportunities here for investors to take advantage of on the equity side?
Well, we're CFTC regulated commodities advisors, not SEC equity advisors. So we don't talk about individual companies publicly. That said, we do look at the silver and other metal mining industries. And, our view is that there's a misplaced hope. A lot of people say, okay, mining stocks have lagged metal prices. Mining stocks often lag metal prices in a bull market, but they play catch up. And therefore, we should expect mining stocks to rise. But I think that may be misplaced, because what you're seeing is not a mining stock problem. You're seeing a equity problem. The equity markets have shifted to where the predominant investment mechanisms are electronic, mechanical trades into indexed futures or indexed options, indexed funds, indexed ETFs. And if you're a large enough mining company to fit into one of those indices, then that might be beneficial to your stock price. But most precious metals mining companies are too small to be in those indices, and they're kind of dropped out. So they're suffering because there's been a disconnect between equity markets and capital formation. And it's not limited to mining. If you look at any index, the TSX, the S&P 500, you'll find that the vast majority of smaller companies are suffering in terms of their equity performance, because investors are not buying equities so much anymore. They're buying indexed funds and indexed ETFs. And that tells us, and then you go into it and you see a lot of secular long-term changes on the institutional investor side. And as a consequence of those changes, most of which are negative in many ways, changes on the sell side of the equity markets. And that's probably not going to reverse, which means that smaller equities, mining companies and other companies, probably will not do as well as a lot of people are hoping. So we have this macro view of the mining equity market, which is less hopeful than a lot of other people's.
Oh, there'll be so many sad people to hear that. I am curious. I mean, you teased a little bit about some new information coming, kind of talking about misguided views when it comes to precious metals out east and in Asia. I know that this is a tease, and I'm not sure when we're going to air this, but just give us a little insight into what that means. Are we overlooking some things here?
I'm not sure that we're overlooking things, but if you look at, if you talk to central banks, and there's a very interesting study done by a think tank in London that was they released their results this week, and they did a poll of central bank reserve managers, and 18% of the reserve managers had said that they expect to increase their dollar holdings over the next 12 to 24 months. They're looking at the dollar in a way that people within the central banking community have been talking about for years on a theoretic level, and you're starting to see it. The idea that the dollar is not collapsing, that central banks are not dumping dollars, that central banks own more dollars now than they've ever held before, and that a lot of central bank reserve managers look at the dollar and they say, okay, where would I put my reserve assets if they're not in the dollar? In the euro, or the Canadian dollar, or the Japanese yen, or the yuan? And you're seeing a reduction in yuan purchases by central bank reserve managers. You're seeing an increased realization that for all of its warts, the United States economy may be in better shape than other economies, and ergo the dollar may be stronger, longer, and may retain its de facto reserve currency status. Now, other central banks and some of those same central banks are saying, okay, so it's the dollar, but it's also gold. They're buying gold and they're increasing their amount of gold, but gold is still very minuscule. You mentioned BRICS in your earlier question.
Right.
Brazil and South Africa, two of the 5 BRICS, don't have enough gold for it to be a significant part of their economy. India and China have the gold stays here policies. So they have no interest in any gold utilization in monetary settlements, international monetary settlements. China is not going to pay for its imports from other countries with gold. They'll pay for it with dollars and euros and anything else, other currencies. And India is in the same mode. As I said, Russia, they have a wartime economy. Something like 75% of their economy is now focused on this war effort. So they're buying and selling gold month to month, buying internally, selling internationally in order to finance the economy and the war effort. So, there's all of this talk about BRICS stocking up on gold is just not there.
But what about the opinion of, the United States weaponizing the dollar, and obviously people within the central banks saying, okay, we need to be at least aware of this. Is that why a little bit more uptick in the gold buying?
There are these things that people say, especially in the gold market. Yeah. And my wife and I just laugh, and it's a graveyard laugh. I mean, anybody who thinks that the dollar has recently been weaponized, must have been brain dead for any period of time since the 1860s. The dollar has always had a political aspect to it. And there's no greater weaponization now than there was in 1978. So it's just not, you hear other things like, with the advent of central bank digital currencies, central banks will be able to see every transaction that you do. First off, they don't care. Second thing is they've been able to see that for decades. Credit card companies give the governments and banks give the governments reports on what their clients are doing. So there's all of this paranoia about what's going on with the dollar and what's going on with central banks and what's going on in the movement to central bank digital currencies that's just totally misplaced. And in the case of central bank digital currencies, and I guess I'm getting a little bit off topic of your question, if you go back to the 1880s, I think it was, with the advent of checks, you had the same concerns. Oh my God, these guys want us to use checks instead of dollars or gold coins or silver coins, so they can see and control what we do and what we buy and what we sell. It's just,
more smoke than fire then, hey, Jeff?
After World War II, there was a coterie of people in the United States government and big business who said, we can't afford an educated voting population. We're facing the Cold War, and if people know too much, they're not going to support our policies. And, so you've seen, back then, there was this whole movement against broadening education. Ronald Reagan in 1980 ran on a platform that he was going to liquidate the the Department of Education. We really want to keep our voters stupid. And to some extent, they've succeeded.
Jeffrey Christian, you're always cutting through the noise, my friend. We appreciate your time today. Of course, Jeff's the managing director of the CPM Group. Hey, thanks for joining us today. I always appreciate your insight into this and some reality checks as well.
Well, I appreciate the opportunity to vent.
Thanks, Jeff. Appreciate your time today. I'm Jeremy Szafron. Stay tuned for more great content, of course, and for all of us here at Kitco News. Thank you for watching. Don't forget to follow, leave a comment, and we'll see you next time.